I'm Darren Stetzel, Senior Vice President of Asia Agriculture at StoneX, and you are listening to our latest AgriAsia podcast from Singapore, where our local experts join together to discuss the latest market developments from a unique Asia perspective. Today I sit down with Kang Wei Cheang, our Vice President of Physical Agriculture Markets for the region, to discuss soybean demand from China, US crop yields, and US biofuel mandates, among other topics. Please do follow or subscribe to the podcast wherever you are listening so you do not miss new episodes. We have some truly insightful markets to discuss every single week, and you wouldn't want to miss one. Let's get into it. Okay, so thank you very much for joining us, Kang. Maybe we'll start with the soybean prices. We saw some weakness this week. What does this mean for Asian importers?
Thanks a lot, Darren. So the soybean complex fell across the board as traders took profits from last week's rally. The market reacted to the EPA's small refinery exemption announcement. We saw the September futures coming under the most pressure ahead of the first notice day. The November soybeans traded in the 60 cents range, falling to a low of $10.46 per bushel. This has left US FOB beans at a discount to Brazil. However, the risk is that if China steps in the later part of this year, freight and price competition could quickly tighten, squeezing the smaller Asian importers out of the market.
Interesting. Thanks, Kang. So if China remains absent from US soybean purchases, how does this shape the rest of Asia's buying?
Thanks. So China has covered most of its September needs, and for October, they have covered nearly 80% from Brazil. This has left US sales to China at zero for 12 consecutive weeks. Thus, we saw a weakening in the Gulf basis and lower CIF values. For other Asian buyers, the absence of Chinese US purchasers is a blessing and a challenge. One hand, the cheaper US beans are available for importing countries like Pakistan and Bangladesh. However, the Brazil premiums have risen quite sharply as the Chinese demands crowd out other buyers. If Beijing decides to rotate its reserve or re-enter the US market later this fall, smaller Asian crushers could face tighter availability and higher costs.
So this market could actually be quite tough for Asian crushers. If we look at the latest US crop ratings, what does this imply for Asia's soybean import outlook?
That's a fantastic question, Darren. So the US soybean ratings have improved to 69% good/excellent, and this came as a surprise for the market. We saw pot counts reaching record levels in several states. At the end of the day, the final outcome will depend on the pot fill and seed weight. But even if the yields fall below the USDA's 53.6 BPA forecast, demand weakness will mean that carryout will still be above the USDA's 290 million bushels projection. For Asia, this means that the downside risk is greatly reduced. Importers in Southeast Asia, including Vietnam, Thailand, and Philippines, can take advantage of the abundant US supplies at discounts to Brazil. For China, it reinforces the flexibility to continue leaning on South America for early coverage while keeping US beans as a fallback option later in the marketing year.
That sounds a little more positive for Asian importers at least. But if we look at the Asian feed market specifically, how is this influenced by US soy meal dynamics?
Yep. So last week, we saw soybean meal futures rising, but we saw the futures price weakening at the start of this week. The September SMU contract topped below 306 before sliding. The tight US supplies from crush downtime have pushed nearby spreads to record inverses, and CIF meal offers have vanished for August and September shipments. For Asia, Argentina still remains the biggest supplier. However, July crush in Argentina fell 14% year-on-year to 3.8 million metric tons, as crushers shifted away from imported Paraguayan beans and relied more on domestic farmer selling. Despite this, Argentina still shipped 2.5 million metric tons of meal, slightly below last year. This has kept flows into Asia, especially China, Vietnam, and Thailand, alive, but it highlights the region's vulnerability. If Argentina's crush pace slows even more, Asian feed demand costs could spike quickly.
You mentioned Argentina a couple of times there. What role does Argentina's crushing industry play for Asian buyers?
Argentina soybean crushers are actually very central to Asians' protein balance. with Paraguayan bean imports shrinking, down 543 tons in July. Argentina plants must source more domestically, which has trimmed the soybean output. That said, Argentina still dominates the global meal exports. For Asia, this would mean livestock and agriculture producers in Southeast Asia, and they remain highly exposed to Argentina's crush pace and logistics. Going to China, we saw Dalian meal prices firming slightly this week as crush margins come under pressure.
That really highlights the global reach of the soybean market, doesn't it? There was also a noticeable weakening of soybean oil over the same period. What impact is that byproduct having on the Asia region as well?
Yeah, so on Monday, we saw soybean oil prices coming back down with soybean prices, with the September futures down 53 points to 54.31 cents per pound, while the October contract was down 44 points to 54.5 cents per pound. The oil share slipped to 48.56%, while we saw the BOU/BOV spread coming down further to minus 19 cents carry. The US ending stocks are projected to rise by 200 to 250 million pounds above the USDA's 1.5 billion pounds forecast. For Asia, US soybean oil remains uncompetitive. Argentina and Brazil's October FOB prices are both cheaper than the US offers. Furthermore, the decline in palm oil price has limited US competitiveness. Last week, we saw Malaysian November futures falling 122 points below their August highs. And with the Malaysian stocks expected to build to 2.3 million metric tons, India, China, and Southeast Asia will continue to favor palm oil over US soybean oil.
Thanks, Kang. You brought up palm oil there. It's another market we're heavily involved in as a business. Is there any correlation between trends in that market and the shaping of Asia's edible oil decisions?
Yes, it certainly does. So palm oil actually sets the tone for Asia's vegetable oil market, as it's one of the largest vegetable oil that's traded here in Asia. Well, we saw Malaysian futures easing recently, and expectations of stronger output and stock builds have added further bearish sentiment to the market. India, which is the largest palm importer, has continued to buy palm as palm continues to trade at a discount to soybean oil. For China, palm is an important blending oil along with the domestic soybean oil crush. Therefore, for Southeast Asia, palm is a default because of its freight competitiveness and availability. This would mean soybean oil will stay sidelined in Asia unless palm weakens significantly or the spread between US and palm shifts.
Interesting. There's one more thing I wanted to bring up. So every week we discuss US policy decisions and the impact they have on all the markets we play a part in at StoneX. For this case specifically, how are US biofuel policies spilling into Asia's soy oil market?
Yeah, so on Friday, we got the announcement that the EPA confirmed that the refinery waivers will be reallocated and the blending volumes will be maintained, which helped to keep the US soybean oil prices supported. We saw the D4 RINs trading between $1.16 and $1.22 on Monday, which was below the $1.30 high we saw in June, but still strong enough to support margins. The firmer energy price also improved US biofuel producer economics by 20 cents per gallon. For Asia, this would mean tighter export availability of US soybean oil. India and Bangladesh, which sometimes import US soybean oil for blending and industrial use, may need to rely more on South America or palm oil. Asian buyers should monitor the EPA's final set rule, which is due on 31st August, as tighter mandates could further squeeze US exportable supply.
Thank you, Kang, for taking the time out of your busy week to join us in this podcast this week. One thing we like to end on with all our experts on the podcast is that following our conversation on what has been happening in the market, what are the key market topics we should be keeping a close eye on in the weeks ahead? And what are the key risks Asian importers should monitor across the soy complex?
Yeah, so I think Asian importers need to watch for several risks in the coming weeks. Firstly, China's potential rotation of government soybean reserves could alter South American availability and distort spreads. Secondly, Argentina's crushing pace remains a cornerstone for the global meal supply, and any slowdown there would directly raise feed costs for buyers in Vietnam, Thailand, and the Philippines. Thirdly, Malaysia's palm oil stocks are expected to rise, and that would reinforce the palm oil's discount to soybean oil. And that would mean US exports will be kept on the sideline in key Asian markets like India. Fourthly, US harvest progress will determine how wide the discount to Brazil becomes, which could actually create a buying window for smaller importers, such as Pakistan or Bangladesh. Finally, the EPA's upcoming set rule is very important. If the EPA channels more US soybean oil into biofuels, Asian buyers will face a structurally tighter global soybean oil supply heading into 2025.
That's great. Thanks a lot, Kang, for joining us and sharing your expertise. Wishing you a really fantastic week ahead.
This podcast is for informational purposes only and is not a recommendation to trade, an investment research, or an offer to buy or sell any financial product. It does not take into account your particular investment objectives, financial situation, or needs. The trading of financial products such as futures, options, or swaps involves a substantial amount of risk and may not be suitable for everyone. Past results are not indicative of future performance. You are advised to perform an independent investigation of any transaction to determine whether any transaction is suitable for you.